Hey, everybody, this is your man, Prof Zones, and Prof is not for professor, but for profits. And yeah, guys, this is the final part of SMC terminology, according to Prof Zones. And yeah, guys, I did leave out quite a lot of definitions, but I didn't want to confuse you too much because there's quite a lot of definitions, right? So already I know some of you guys are confused and think this is a lot of definitions, but really it's not. I just wanted to give you definitions that you probably will hear about more than others, right? So yeah, as you know, last definition that we were doing on part 2 is premium market, below 50%, right? 50%, which is discount and premium. So that's where I stopped, because part 1 I also stopped at discount market. So yeah, guys, with that said, let us move into the next definition. Boom. Sell side liquidity, abbreviated as SSL. So whenever you see SSL, just know that we're talking about sell side liquidity. And whenever you hear sell side liquidity, just know that we're talking about this, right? So sell side liquidity is the orders that are trapped below a low, like sell stops and sell limits, also stop losses. When triggered, price then goes the opposite direction in the form of buyers taking charge, or a retracement, right? So basically what we're saying, let me go to the chart. So basically what we're saying, guys, when we're talking about sell side liquidity, is simple. Basically what we're saying is, okay, let me get rid of all of this. Basically what we're saying is that it's SMC language, right? It's smart money concepts language. So when we are talking about sell side liquidity, we are basically saying that we are pushing the market lower so that it can take the stop losses of dumb money or retail traders, right? Guys, and when we say dumb money, we're not saying you guys are dumb. It's just the opposite of smart money, right? We're not saying people that trade retail, because we all trade retail at the end of the day. It's just that smart money concepts are a more advanced price action, right? Where it basically focuses on how price books instead of reacting off of a price. Example, we won't trade the third touch or stuff like that, right? Because that is more reactive. We understand why there is a third touch. So smart money is all about that, understanding why there is a third touch and most likely where will it be, right? So yeah, when we're talking about sell side liquidity, as you know, buy side liquidity is on the top, sell side liquidity is on the bottom. So this low right here, guys, let me annotate it properly for you. This low right here can be taken as sell side liquidity. Why? Because retailers and dumb money, so to say, would take this as support, right? That is support. And then price hits resistance, and then they're expecting for price to come back and respect this support so that it can push up. But us smart money traders, we are the ones that are actually pushing this market down so that it can take out the stops, right? Hence why we say we trade with the banks. So that's what banks would do. They're looking for liquidity. Liquidity meaning they're looking for money. They're looking for fuel, so to say, right? And the fuel for the buys are where? Below the lowest low in this trend right here, in this push right here, which is sell side liquidity, right? So with that said, after the market taps this sell side liquidity, what are we looking for? A change of character to the upside on a lower time frame so that we can get involved in the buys. And if you're in the same time frame, you look for price to close above that sell side liquidity, and then you can actually get involved. In fact, I've analyzed this on the daily, I think the first week of Monday market mapping, and that worked very beautifully, right? So the sell side liquidity is basically liquidity of all the stop losses. So there's a lot, guys, of stop losses right here. Why? Because everyone that bought over here in all of these wicks that you see, everyone that bought there put their stop loss where? Below the previous low, which is here. And they take that stop loss and then they push the market all the way up. So the buyers now are taking charge, or it's just a retracement. In this case, this is just a retracement into what? Into this order block right here. And then the market is going to now drop, right? Into where? This trend line liquidity over here, right? So basically that's what this is. So yeah, guys, with that said, that's what we call sell side liquidity. Sell side liquidity is resting below your previous lows. So with that said, let's go into the next definition. Smart money. So as I was just saying right now, guys, when you hear the term smart money, right, this is the definition. These are the smart, informed, and savvy financial institutions that invest, of course, buy or sell, their large capital into different financial markets. Subsequently, smart money traders are people who seek to follow how price books and why it books instead of just reacting from price movements, just like how I said right now. So smart money is basically all the huge institutions that focus on higher time frames and that do not really focus on lower time frames as much, right? So yes, they do pay attention to lower time frames, but the smart money are people that put their money behind larger movements, right? So they're always looking for where is the retail money so that we can fetch that retail money and then go the opposite direction. But when they're doing that, they're inducing retail traders to go the same direction that they're going, just so that they can go against them. So smart money can easily put 100 million in buys just so that they can reach a certain level and put 300 million in sales, right? And they book that 200 million profits, basically, right? So smart money, as you know, as they are the smart, informed, and savvy financial institutions that invest their large capital into different financial markets. And then now let us move into the next definition, which is smart money concepts. So smart money concepts is a more sophisticated method of price action, as I said, right? To spot, identify, and locate where smart money is buying and selling their positions. So smart money are the banks and large institutions. Smart money traders are us, which are more advanced price action traders. And smart money concepts is what smart money traders use to follow smart money. Do you get that? Do you get that? Because smart money traders use concepts like what I'm explaining in this this series called SMC Terminology. We use those concepts to actually basically follow where the banks is putting their money and where the banks is not putting their money. So you see, so like I'll make a simple example. If Goldman Sachs is basically going to put 200 million in a specific asset, they won't put the 100 million at once. They'll probably put up like 80% of it first, right? To induce retail traders, which is everybody else, that, okay, we are buying, this is a buy trend, just so they can reach a specific level where there's a lot of stop losses of retailers. And then guess what those retailers do? Those retailers are then going to add more orders when other retailers are being taken out the market. And then they double down and double the amount in the opposite direction, which creates what? Liquidity. Hence why you'll see when markets reach a certain point of liquidity, guess what they do? They start to react. As you saw on the previous example, right? They start to react, and they might react on the opposite direction more often than not. So basically that's what smart money concepts is. It's not smart money trading, but it's concepts that smart money traders use. So the next definition is basically a sweep of liquidity, right? So that's smart money sales. A sweep of liquidity and a grab of liquidity is two different things. Please do not get that confused, right? So the definition of a sweep on buy side liquidity is basically when price sweeps a low and retail traders, sell stops, and their sell limits are activated, including breakout traders. So that is a sweep on buy side liquidity, as retail traders get stopped out and smart money buys their positions, right? So a sweep on buy side liquidity is not a grab on buy side liquidity, right? So now let me go to the chart and show you what that means, because some of you guys might be confused as to what that means. So a sweep on buy side liquidity would be what I just explained right now. Where the sell side liquidity, what do we need from it? We need a sweep of that sell side liquidity. And when we are going to do that, what do we call it? We call it a sweep on buy-side liquidity, because guess what? We are engineering buy-side liquidity by sweeping sell-side liquidity. So when the market is pushing all the way down, guess what it's doing? It's sweeping all the stop losses and sell limits and breakout traders that are here. So imagine if you as a retail trader, right above this low, you have put your sell stops. And then what would you do? Put your stop losses probably above the previous candle. So what just happened? All those stop losses have been taken. So that is now that buy-side liquidity has been generated, right? So the market did go in your favor for like a couple of pips and then went against you just to go to your stop loss. Then that's what others would call what? Stop hunt. We don't call that stop hunt. We call it a sweep on liquidity, right? So basically that is what sweep on buy-side liquidity is. And subsequently the opposite should be the next definition. But yeah, so a sweep on sell-side liquidity is basically smart money buys, right? So when price sweeps are high and retail traders buy stops and buy limits are activated, including breakout traders, that is a sweep on sell-side liquidity as retail traders get stopped out and smart money buys their positions. So hence why in brackets, it's called smart money buys, because the smart money is buying just so that it can sweep that sell-side liquidity, right? So basically, let me go show you that on the charts again. So right here is where your sell-side liquidity is. Right here. Right here is where your sell-side liquidity is. So when smart money buys into that sell-side liquidity, what is it doing? It's trying to activate all of those buy stops, all of those early seller stop losses, and all of those buy limits, right? Basically. So when all those pending orders get triggered, then what does smart money do? They do the opposite. But they are the ones that push the price to go up there, right? Hence this huge candle. Look at how big this candle is compared to every other candle that came before it. Why? Because there was a lot of money injected into that candle. There was a lot of money injected into that candle just so they could what? Sweep that liquidity. And after they sweep that liquidity, what did they do? They put in more amounts of money in the opposite direction. Hence then the market started to drop, to chase what? To chase the sell side liquidity. And then they do that again in the opposite direction to tap into a point of interest, which is what? Our order block right here. And then the market will drop after this into where? Chasing all of this liquidity and this trendline liquidity right here. So that's basically what a sweep on sell side liquidity is, right? That's basically what a sweep on sell side liquidity is. Now let's move on to the next definition. And I think that is actually the last definition. Yeah, that was the last definition. So yeah, guys, there's actually more, but yeah, this 3-part series is over now. And for me to go deeper into other definitions, it's basically going to be just free lessons on my YouTube channel. And yeah, because there's a lot that I didn't mention, like distribution, like manipulation, order flow. There's quite a lot, guys. There's actually quite a lot, but all of them tie into the same thing. And the more you understand smart money concepts, it's actually the less concepts you'll need, and you'll just focus on specific models. Just like I always tell my clients that for you to simplify something, you need to understand it in its entirety. Because if you do not understand it in its entirety, how can you simplify it, right? So you need to complexify it before you simplify. So if you don't understand what it is in its entirety, you can't actually make it simpler for yourself or others. So with that said, I just wanted to cover the most known terminologies when it comes to smart money concepts, as of course according to Prof Zones and not Michael J. Huddleston. So yeah, with that said, guys, I'll see you on the next series, which won't be about SMC terminology, but probably will be about just free lessons as to specific smart money concept and models. So yeah, with that said, I hope you enjoyed this series, guys. I'll see you in the next one.